Hi, this is Emily with RE/MAX Universal, here to talk about loans, closing costs, and all this kind of things that you need if you're planning to buy in the next 3 to 6 months. If you want to buy a house, the very first thing you need to do is find out if you can get a loan and how much. Otherwise, you will face massive disappointment, and it's kind of like that joke there. Why do you need a pre-approval? Well, a lot of sellers will not let you in to see the house. Also, if you start looking online before you know how much you can borrow, it can really mess up your expectations. Unfortunately, a lot of people overestimate what they can afford, and then they're disappointed when they find out what their real level is. Some people underestimate, and then again, they wasted their time looking at houses that they didn't need to look at. And finally, if you can't yet get a loan, a lender can help you. They have credit repair programs. They have other ways sometimes to be able to get you to get a loan. Once you get your pre-approval, you might feel like there's literally nothing in your price range. However, in Wisconsin, that's not that true. I know this because in 2025, I sold a house for under $140,000. In 2026, I sold a number of houses under $200,000, and the buyers all stayed within their budget, and they were happy with the houses that they got. Loan basics are that you are going to have to provide a lot of documentation. It's all here. It may seem like an awful lot of work, but your lender has to have this data in order to find out your loan amount and your interest rate. They have to look up your credit score as well. They do like to see a 2-year employment history. However, if it's not exactly 2 years, talk to the lender. There are ways around even this, but they need to know exactly what happened. Loan types can depend on your credit score. Government loans will require not only the borrower but also the property to qualify. Most loans do require a down payment, but good news is that you can get down payment assistance, DPA. If you do need down payment assistance, this can come through either WIDA or maybe in-house through some program that the lender has. And I'd like to point out that different loans require different amounts of down payment. For example, VA loans are famous for being 0% down. And if you're getting a rental property, an investment property, you might have to pay 25%. If you don't qualify for down payment assistance, there are ways to bump up that fund of your required down payment. And they're listed here. Remember, you are not buying a sticker price, you're buying a monthly payment. That is what you have to focus on. And here is the importance of interest rates. That monthly payment that I said you're buying is the triangle in the middle. That is the constant. That has to stay the same. When rates go down, money is cheaper to borrow, and therefore you can buy more house. When rates go up, the amount of house you buy goes down because they work against each other, and that middle triangle has to stay the same. Your credit score is not the same as Credit Karma, and as I said, it can determine the type of loan you will get. You want to avoid too many hard inquiries because that can hurt your credit score, and please, please, please do not get any kind of new credit, even a 0% down loan in one of the big box stores, because that could affect your ability to buy a house. How much will you borrow? Well, there are two approaches to this. One is to find out how much you're allowed and go for it. This means you're stretched to the max, and it could be more than you comfortably want to pay. However, if you do max out, you're going to have to adjust your lifestyle to accommodate that bigger house payment. I'm not saying it's impossible. I did it, but it can be very uncomfortable for a lot of people. So really the better way is to figure your monthly payment that you're comfortable with and then tell your lender to calculate backwards how much of a loan you can get. That's a lot safer and a lot more comfortable for a lot of people. Your closing costs are what your lender charges to complete the loan plus what they call prepaids. That is escrows for insurance and taxes. Closing costs can be asked from the seller in the form of seller concessions, but it's not a good idea in a really hot seller's market. I want to say though that in 2026 I had a number of offers accepted and closed where the buyers asked for seller concessions. And closing costs can vary widely. This is why you want to talk to your lender and ask them to spell it out, put it in a list, and explain each item. Higher ones can mean lower rates. For example, I had a buyer who had to pay points to buy down the rate enough that the monthly payment, remember I said you're buying the monthly payment, that was small enough to fit in their budget. If they did not pay the points, their monthly payment would have been too high and they wouldn't have been able to get the loan. So they had to pay the points. That led to higher closing costs. However, when you do pay higher closing costs because of points, it can benefit you because you have a lower rate, which means you're paying less money over time. Lower closing costs can result in higher rates, but you don't need all that money up front. What if the lender says you have to ask the seller for the closing costs? There's a slim possibility of it hurting your chances of getting your offer accepted, but that's usually only when it's a super hot seller's market, which in 2026 we no longer have. We do have a seller's market, it's just not red hot. It could be the only way to get the loan to work, and it keeps you from having to pay the costs directly, which is a benefit to you because they get rolled into the loan. You want to calculate how much you need in terms of earnest money. This is something you can't get away from. You cannot roll this into a loan like closing costs. You have to have this cash. It is a deposit that has to be paid into a trust account within 5 days after the offer is accepted. It should be a cashier check or electronic funds transfer, and it is credited to the buyer's account on the closing paperwork. So it's not as if you lose it, it's there. It's taken off the total amount that you owe at the end. But you do have to have this cash up front. You can even pay an inspection fee with a credit card, but appraisals usually you have to write a check to the bank. Cash to close, that's what you have to add up, which is your down payment, your closing costs. Sometimes the appraisal fee is rolled into that. Usually you have to pay for that before you close. So your next steps when you're house hunting, after you've got your pre-approval, you want to get an MLS search set up, and you can get a buyer checklist plus other information from me. It's fast and easy. Just contact me. If this is useful or you know someone it will help, pass it on.
And that's it for now. This is Emily Matthews here to help you with all your real estate needs. Don't forget to subscribe. It's the little icon with my head on it. Have a wonderful day.